Good evening, everybody. Thank you very much for joining us here at Pacesetter Capital for another webinar. We're excited today to give you some information about real estate. It's a passionate subject of mine. I hope you're going to leave today's webinar having learned some things. And if you have any questions from today, you can pop them in the chat or one of the team will get back to you afterwards. We've got an absolutely amazing agenda. To start with, my main aim today is to provide value to you. This isn't a webinar where you're going to be sold something or offered something. Today's all about value and just as a way of thanking you for investing your time with us, to be able to give something back to you and in terms of some knowledge about real estate. Then we're going to introduce real estate a little bit more. We touched on it last time, some very basic things. We're going to go to a bit more in depth today about some different parties that are involved in real estate in terms of agents, brokers, solicitors, that type of thing. Then today's topic is about risk and market cycles and scaling. So we're going to talk about that. We're going to talk about how Pacesetter looks at risk. We're going to look at how the different ways you can scale up, whether it be slow, whether it be fast, and why fast might not always be good. We're going to talk about market cycles. We'll talk a little bit about where I think we are in the real estate market cycle and the 4 different cycles that we can be in, or the stages of the cycle. And then we're going to finish up today talking about a little bit about stock investing. I mentioned last time, this is my first love of investing. The first investment I made was in stocks. So we're just going to spend a few minutes at the end of each webinar just talking about that, just because I know that a lot of you are interested in investing in general and maybe not specifically real estate investing only, but other types of investing as well. Okay, so let's kick off part 2 of our intro into real estate. So I'm going to talk a little bit about the different parties we come across when we're making real estate transactions. I'm going to be talking from the perspective of the buyer, because if you're investing in real estate, you're buying and selling, but you definitely have to buy first, of course. So let's go through each of these in turn and just describe a little bit about what they're responsible for. Okay, so our first picture on the left is clearly an agent. Okay, he's showing a couple around a property, and we have to deal with them as buyers. You can deal with a seller directly if you can find out their contact details. In other countries, that might be easier. For example, I know in Estonia, that's a bit easier. But in the UK particularly, there's definitely a kind of wall around the seller that the agent puts up, because obviously that's how they make their money and their commission. So when you're dealing with agents, when you're going into properties, you want to make sure that they seem like they know what they're talking about. If you have questions about the property that I'm sure you will have after, looking at a valuation report or by making some initial assessment of the property, you should have some questions, and how they answer those questions, and if they have the knowledge, or if they say, I need to call the office. That's a very big takeaway of how good an agent they are. A good agent as well will work with you constructively, because they also, to get their commission, they need a buyer. Obviously, they're officially working for the seller, but to make a deal go through, they need you as well. So they need to take into consideration that they want to make a deal with you, and so they should be somewhat able to work with you in relation to things like price and questions and things like that. Okay, middle picture is a mortgage broker. Now, unless you're a very, very wealthy, depending on the area, and you're paying in cash, you will need financing. Financing is a big topic that we're going to be talking about later on in the webinar. But a mortgage broker will basically arrange the financing for you. So they'll ask you some questions. You'll need to complete a kind of questionnaire related to your circumstances, where the money's coming from, how much deposit you're putting up, down payment, for those of you that are in America. And they'll take that all into consideration, and they'll say, okay, based on what we've learned about you, I believe this would be the best finance product. Now, if they're a good broker, they'll be able to take that finance product from the whole of the market. So in the UK, I believe there's about 200 lenders that will lend on properties. Not only, some will only deal with residential purchases, so for someone that's moving in to live in, but there are specialist lenders that will deal with home purchases and investment purchases, and a good broker will be able to guide you through that process. And then finally, a solicitor. Solicitors are very important. They work on your behalf, and they make sure that everything's up to date with the legal side of the property. So they'll make searches on things like the land registration site or portal or organization, whatever country you're in. And they'll make sure that the owner is actually the owner. If you're in America, they'll have a look and see if there's a lien on the property, like a kind of previous debt that's on the property. But in Scotland, it's fairly easy. We have a register that shows ownership going back hundreds and hundreds of years. It is a little bit tedious because you'll have someone that might have put a rule on the property, like, no sheep can be sold here, and it's from like 1812, and that needs to be like on every time the property is transacted. So it is a little bit of a hassle for them, but it's really important to get a good solicitor. And yeah, that's one of the things I'll be giving you advice on later on. Okay, so let's talk a little bit about financing. Why should we get financing? Why should we get a mortgage? Now, obviously, each person's circumstances are specific to them. It may be beneficial for you to pay cash, but generally, it's better to get financing, and that's kind of articulated by this slide. So let's say your target market for your apartments costs £100,000. All right, and let's say you only have £100,000 to spend to invest in property right now. So the question is, would you rather have one apartment or would you rather have four? Now, that's a pretty obvious question to most people. It might depend on your circumstances, but for myself, I probably would rather have four. So with your cash, if you're paying 100,000, you can only get one apartment. But with the magic world of financing and using mortgages, you could get four, not including fees. In the UK, generally, if you want to buy a property as an investment, you need a 25% down payment. So that would obviously be £25,000. And so you could, in theory, get four. Now, obviously, there's fees and you need to pay solicitors and things like that. So this is a very kind of basic example, but just to illustrate the benefits of financing. Obviously, you would have extra costs in terms of paying for the mortgage, but obviously you'd be getting more money than that in profit from the rent after paying off the mortgage. So that's a quick intro into the benefits of financing. Okay, so let's go through the steps. Now, last time we covered in a little bit of detail how to find deals or where to look for deals. So that's obviously the first step, is to go on your local portals and find deals. In the UK, there's a big portal called Rightmove. So it's rightmove.co.uk. And if you go on there, if you type in any city, any town, you'll find properties for sale on that portal. Next step is to view the property twice because it's so important. You need to go ahead and view and take a look around. Don't just assume that you cannot go there and everything will be fine. There are some cases where if you're an experienced investor, if you know an area very well, if you've done a lot of deals, then there may be a reason that you might get away with not viewing. But I would say in 95 out of 100 cases, to be honest, you'll need to go and view. So definitely go and do that. Look for any issues, check everything's working properly, things like the electrics, things like the shower, etc. Then once you've viewed, go ahead and make an offer, agree a price. Usually you'll do this through the agent. In Scotland, what usually happens is you'll make a kind of informal offer to the agent, and they'll relay that back to the seller. They'll come back and say, yeah, okay, we can make a deal based on that. And then you would make a formal legal offer through your solicitors. All right, and then they'll send that to the agent. It will then get formally accepted, and then the next step will begin, which is the legal and financing process. So you'll go through that. That can take, in Scotland, it might be 8 to 16 weeks, so 2 to 4 months, depending on how quick the legal process takes, financing, etc. And then finally get the keys, and you can get going on getting furniture in and things like that, and getting it ready for someone to live in. Okay, so what are some things that can go wrong? And these are all things that have happened to me in the past, so definitely lessons to learn from. You need to get your team right is probably the main lesson, but let's go into them. So number one, you might not be able to get financing because of how the building is constructed. So in Scotland, if the apartments are built in a certain way of certain materials, for example, concrete, the lenders don't like that. They prefer things like it to be made out of bricks. So yeah, concrete would be a no-no. You might still be able to get financing, but it would be more expensive. If the lender's fine with the building, but it's like not a usual construction, they might require an upfront deposit of 30% instead of 25%. That's happened to me once when I asked about a property. And that will return your calculations, because the deal might work if you're only putting in 25k, for example, just for easy numbers, but the deal might not work if you're having to put in 30k. So yeah, just bear that in mind. You might find it difficult to get a solicitor to work with you. because of money laundering requirements. Here at Pacesetter, we have a lot of shareholders. We have a lot of shareholders from Europe. And so we have found it sometimes difficult to get a solicitor to work with us because they might think, oh, where's the money coming from? But we have found a very good solicitor now that is working with us and is very on the ball. So just bear that in mind if you're even in your own country, like if you can't prove where the source of funds is coming from, sometimes it can be difficult. So your mortgage broker might not be able to find you a suitable loan because the interest rate is too high. So you could do your calculations based on that you were going to get a 6% interest loan, but then they go away and come back and tell you, oh, you can only get a 7.5% loan. And that those higher interest payments will work against you when you're working out your calculations. And also solicitor delays in the UK, all across the country, solicitors tend to be quite slow because of the amount of work they have to do. We're a very big country with not a lot of solicitors, so they usually have a lot of workload. They have to process dozens of transactions at any one time. So it might not be that yours gets priority all the time. And there's not many of them. And like I said, we have a lot of ancient kind of things we have to go through with the solicitors, like I said, with these rules that were put on from hundreds of years ago, because unfortunately it's one of the we have a proud history and a long history, but there's some negatives to that sometimes in terms of bureaucracy and things like that. All right, so let's get on to Pacesetter and our attitude to risk. Hopefully we're going to take some lessons away from here. So one thing we're very, very keen on, all right, is paying down our debt on our properties. In the UK, there's something called a repayment mortgage and an interest-only mortgage. All right, now that probably, even if you're not too familiar with real estate property, you should pretty much kind of understand where I'm going to go with this and the differences. Basically, an interest-only mortgage is when you're only paying off the interest payments each month. All right, so if you have a 100K loan and your interest rate is 6%, okay, the interest you're going to pay in a year is going to be 6% of 100, which is 6K. And then you're going to need to divide that by 12 to have your monthly interest payments. All right, makes sense. Now, a repayment mortgage means you're also paying off some of the amount that you've borrowed. Okay, so in our example of 100K, with a repayment mortgage, you're also going to pay off a proportion of that 100K each month. It's only going to be a very small proportion, but it's still going to be some of the proportion nonetheless. Now, there's pluses and minuses to both. Obviously, with an interest-only mortgage, you're going to get more initial cash flow because you're not paying off that little bit of the principal of the initial 100K each month. All right. But the downside is that amount of debt stays there. All right. You're not really kind of paying off the debt each month. Now, a lot of property investors, I might even say most property investors, will go with the interest-only option because they want that maximum amount of cash flow. However, with Pacesetter, we're trying to be long-term, we're trying to be sustainable. So we are using repayment mortgages, okay? Even though we're paying off a little bit each month, and even though it means that we get a little bit less return, we're trying to be as safe as possible when it comes to debt. Another thing that we'll try and do is we'll overpay the mortgage when we can. So let's say we've made 20K in a year, we've returned 15 of that to our shareholders, and we have 5K left over after everything. Most likely, we'll use that to pay down some debt, just to make sure that we're not too leveraged. All right, and that's kind of evidenced in this slide. So I need to introduce the term loan to value to you. All right, so what that means is if the value, there's a really good example here. So let's just go through that. Emily has 100K to buy a house, but she only has a £10,000 down payment. So she's going to need a 90,000 loan to buy the house. So her loan to value is 90%. So that means 90% of the loan value, the value of her house has been paid for by loan. Basically, that's an easy way to think about it. And she owns 10% of the house, basically, in a way. All right, so what we start with in investment properties, this would be fine for a residential mortgage. No problems with a residential mortgage, you'd be able to do that. But for an investment mortgage, you would need at least a 25% down payment. All right, so in this example, Emily would need 25,000 to buy the house, and she can borrow 75,000. All right. Now, and that's the case with us. When we are first buying our properties, we buy them at a 75% loan to value ratio. However, long term, we would like to be paying down that debt so that in the next 2 to 3 to 4 years, we would be having a 65% loan to value ratio, okay? Just to make sure the debt is manageable, okay? Because why a lot of people got into trouble during the financial crisis in 08, 09 is because they were too highly leveraged, all right? So Emily's going to be in trouble if she has a house that is valued at 100,000 initially and she has a 90,000 loan on it. Imagine the value of this house went to 80,000, and the values of UK properties did go down by 20% in some areas during the financial crisis. She now has a 90,000 loan against a property that's only valued at 80,000. If she needs to refinance whilst that's still applicable, she's going to be in trouble, and the bank may recall that loan. All right. So we want to have even though we're kind of protected already because we have a 25% down payment, we still don't want to take chances with that. All right. And this basically explains this slide covers what I just explained. So we don't want negative equity. All right. So we need to prepare for the values of our properties to go down 20% or more because someday they might. All right. So we take a pretty relatively conservative attitude to debt with Pacesetter. We might not need to, but there's some risks to that, which I'll explain in some future slides. All right, so now we're going to talk about how to scale up. So now we're going to talk about how do we grow a portfolio? How do we go from 1 property to 5 to 10? How do we get bigger, basically? So there's 2 ways we can do it. There's a couple of fast methods, and there's a couple of slow methods. All right. So we're going to talk about both of these in turn, and we're going to start with fast scaling because I'm sure that most of you on this webinar are thinking, "Hey Ash, I want to scale fast." Okay. So let's tell you how to do that. So I'm going to show you some numbers for this method in a sec. All right. But the first method is called the BRRR method, or the Brewer method. All right. That stands for buy, rehab or refurb, rent, refinance, and repeat. All right. So if you want to get a note of that, for those of you that are making notes, the BRRR method, obviously there'll be a recording of this if you do miss that. Okay, so let's go through the numbers for a BRR method. Okay, so this is imagining that you're paying cash. All right. So let's imagine for a second you have 80,000 cash, and we'll tell you how this works. So you have 80,000 cash, right? You buy a property for 50,000. All right. You spend 25,000 refurbishing it. So putting in new floors, maybe putting in new windows, upgrading the boiler, etc., etc. So you spend 25,000 on it, getting it into a good state, basically. You spend £5,000 on your other costs. So legal costs, so stamp duty. So in the UK, it's called something else in Scotland, but it's known in other parts as stamp duty. So when you buy a property, you need to pay the government a certain tax. Solicitor fees, survey fees. So your fees are 5,000. So you've spent in total £80,000 on this property. All right. Now, the done up value, so the value now that you've worked on it, all right, is £100,000. All right. So you can now get a mortgage. You can get financing for 75% of this value. All right. So you get back 75% basically of that value. So back to you is 75,000. You've spent 80. And so the actual amount of money, once everything's done, that you've spent on this property is £5,000. All right. So if you have a pot of £50,000, you can have multiple ones of these going at one point if you have some in reserves, obviously. So depending on your finances, you can have multiple of these going at any one time, and then you recycle the cash into something new. All right. So that's one of the slow methods. One of the fast methods. Okay. Now the second method of the fast is using a bridging loan. All right. So what we do is you use a 90% bridging loan. So what this means is you're getting a loan for 90% of the purchase price. All right. So you're actually putting in 5, You're spending 25 on refurbish, you're putting in another 5 on legal, so you've actually put in 35. All right, so you need to pay off your initial bridging loan, okay, which is 90% of the value of the property. Okay, you're getting 75 back again, and so still your money left in is 5. However, you've spent less because you're using a loan this time instead of spending cash. Now, let me use a real life kind of example, just to kind of bring this to life a little bit more. Okay, so I'm going to explain to you now how we could have paid just £1,750 for one of our apartments. All right, and this is real. It's not including fees and interest. Okay, so we're just ignoring that. We're just talking about the straight purchase price. All right, so we purchased a property for 73,000. We could have used a 90% bridging loan. All right, it is difficult to get them, but there are providers that will do that. It's more like 85%, but it is likely that you'll find a provider for 90%. So we put a down payment of 10%, which is 7,300, and we got a loan for 65,700. All right, at a commercial valuation, okay, at a commercial valuation, we could have got 95,000. We could have got a valuation of 95,000 for this. All right, I explained the difference between market value and commercial investment value in the last webinar. It's basically based on the property as an investment rather than an apartment to live in. Okay, so if we had refinanced at a commercial valuation of 95,000, we would have got 75% of that 95,000 back. All right, so our initial loan on the bridge is 65,000. Our new loan on the new valuation is 71,250. So we get 71,250 back. We use that to pay back the initial loan of 65,700, and that leaves us with 5,550. All right. We initially spent on the down payment 7,300. So take that 5,500 away from the initial 7,300, and we have left 1,750. All right. So hopefully that this screenshot breaks it down nice and easy, kind of visually. All right. So we could have paid, after everything's done, just 1,750 for this apartment. However, why didn't we do that? Okay, and it goes back to what we were just saying about risk. What we would end up with is a £71,250 loan on a property that we bought for 73,000. Now, the actual value of the property was more like 85, all right, but it's not within the realms of impossibility that there could have been a crash and that 85 could have gone down to a 65 or a 70. All right, and we could have been sitting on a loan on a property that's worth 70,000 that we have a 71,250 loan against. That is the reason why we didn't go down this route. Okay, we are very, very averse to risk. Now, as I'll explain later, there are situations where we may be open to do something similar if it stacks up, but that's one way you can scale fast, but you have to accept the fact that there's some additional risk in terms of that. All right, so let's now talk about slow scaling. All right, how can we build our portfolio nice and slowly? So the first way is just to do conventional investments and then just reinvest the income. All right, so this is an example property that we looked at a few months back, maybe 4 or 5 months back. What this shows is that we could have made about 24,000 from this property after a year, and then in a year's time, we could use this 24,000 to do something else. All right, so to just build up every year when we get our income, and so we're just building up slowly as and when we get the income from our properties. Okay, so that's the first obvious kind of slow scaling way, is just reinvesting any profits that you get. Now, scaling 2 is similar to option 1, pretty much the same as option 1. Okay, we look for properties that meet our requirements, but we additionally find partners to basically invest with us. So to buy shares in the company and to buy with us. Okay, so this allows us to buy more than if we were just using our own funds. All right, so similar to option 1, but also finding money from elsewhere. Okay, now slow scaling option 3 is really slow, but this is a way that people that are in the older kind of generations, in their 40s, late 30s, 40s, 50s, start to get into property. When they're in their 20s, or nowadays it will probably be 30s, but back in the day, in their 20s, they bought a 400k loan, and let's say they bought it with a 100k down payment. Probably it was less than that because things were better in terms of getting lower down payments back then. But let's just say 100k loan. 100k down payment with the 300k loan. They don't do any refurbishment, and let's say in 10 years' time that property is now worth 500,000. So it's gone up 100,000 in value. So now they refinance with their 25% deposit, okay, and now 25%. They're going to get a 75% loan on the 500k, all right, which gets them 375. They pay back their initial 300k loan. This doesn't include any payments. Obviously, over those 10 years, they've been making payments, but we're just making the numbers nice and simple. This leaves them with 75k that they can use to invest elsewhere. All right. So this is how most kind of mum and dads get into property, is they just refinance and they use that extra equity to buy their second or third apartment. All right. So that's slow scaling option 3. So what do? We do a mixture of mostly slow scaling option 2, and occasionally we will use some bridging loans if the numbers are right, like I said. So basically what we do is we have shareholders, people buy shares in Pacesetter, and we use those funds to buy properties. All right, obviously we're getting income as well, but every year mostly we'll be buying properties by attracting shareholders. And then, like I said, when the time's right, we will do a bit of fast scaling as well. All right, so let's talk a little bit about market cycles. Okay, so in the expansion phase, basically things are going up, property prices are going up, there's a lot of occupancy, and there's increasing construction activity. That's basically what we're in at the minute. Peak is when there's an oversupply, okay? There's some kind of economic event that disrupts things, kind of like there was in 08, 09. Recession, rents are low, and this is when it's a good time to buy assets. So obviously, if you've been buying assets in the end of 2009, 2010, you would have done well. Recovery is when things start to go back up again, okay? So this would have been 2011, 2012, 2013. At the minute, I would say we're in an expansion. You know, prices are going up, rent, there's no problem finding tenants, construction's happening. All right, so we're in the expansion phase, and when we get into the peak phase, you'll know it because there'll be less demand and there'll be some kind of economic disruption. So how you make the most of that is you combine scaling with market cycles. So best time to buy is during the late recession. Be cautious during the peak period and focus on cash flow all the time, but basically, especially during the recession period. So let's finish off final 2 minutes with some principles of stock investing. You want to buy when there's a margin of safety, okay? So if you think the value is there, you should be buying below the value, obviously. And in future webinars, we'll show you how to decide what the value is and whether it's a good time to buy. But you always want to buy when you think you're buying for less than the company's worth, of course. Now, there's a difference between market price and intrinsic value. Okay, this is a real big lesson. There's a difference between price and value. Sometimes a stock can be overvalued. Sometimes a company can be undervalued, and it's knowing the difference between those is how you become a successful investor. And the final thing I just want to share with you is, remember, when you're buying a stock, you're not buying something that goes up and down every day. It turns green, it turns red. You are buying a part of a business. When you buy Apple stock, you are buying a very, very small part of Apple. Okay, when you buy Amazon, exactly the same. So when you're buying stocks, you need to act like you're buying a business, okay, not just buying something that goes up and down all the time. Okay, you need to assess it like you're buying a business. All right, thank you very much for coming. Our next webinar is already live, so go ahead and click attending for that one. It's going to be about managing properties and maximizing your cash flow. You can find that on our LinkedIn page. You can also follow our Instagram at Pacesetter Capital, and we'll look forward to seeing you again in 4 weeks' time on the 18th of June. Have a wonderful month and speak to you very soon. All the best.